Hey students, welcome to the week. And in this week, what we're going to do is really wrap up this financial analysis. And to do that, I'm just going to use last week's homework and kind of go over a detailed summary of how it works. And I'm going to use Microsoft Excel. It also relates to how the exam will be given to you in this section. So it's important to see how I calculate these values and understand a little bit why. So get your homework out, take a look with me as I go through this, and hopefully it helps. I kind of reorganized the page so I can maybe show you a little bit easier the whole page at one time while I calculate these things. But we're going to begin with the homework you had last week. And I'm going to begin with the balance sheet. Now, what we're going to talk about here in this section is two ratios. One's called liquidity, one's called solvency. Liquidity is all about, so this whole section here is all about how you can manage short-term assets with short-term liabilities or debt. And so that's kind of what this section is all about. That's called liquidity. Solvency is about how to manage long-term assets and the long-term debt or liabilities that go along with that. And that is what solvency is all about. And to do that, there's some ratios that are really common, and these are pretty simple. The current ratio, you've already got the formulas for that, but I'm going to press equal so I can write these here. And so I've got business A here, year 1 and 2, and I've got, let's see, current assets right here. So 219,820 divided by, that's current assets divided by current liabilities. So I just go down there and grab current liabilities, and when I hit enter here, you can see that that is a 1.04. I'm going to put a comma format there, so there it is. Now, one thing about managing short-term assets is on current ratio, we want it to be really equal to or greater than 2. And so that is actually a formula there. Let's do that needs to be equal to or greater than 2. And that means you want twice as many. In this case, at 1.04, we do not have twice as many. So that is not a good current ratio. Now, this formula that I've written is really handy like it is because I can just simply copy and paste it over to the next cell. And so now for year 2, it looks like we have grown to 1.38. So this is not necessarily a good ratio here. In fact, the answer for this would be not so good. We would really kind of not like this. And again, the video last week also helps you with this, but that's what we'd be looking at. This is not really a good current ratio. We're barely covering our current assets. We have 219,820. We got liabilities of 218,270. Anything goes wrong here and all of a sudden you are not liquid. We're liquid here. We just have enough, but we don't have the goal. 1.38 is getting a lot better. We still don't have the goal, so this is not so good. Now, working capital gives you the dollar value of that stuff. So really, it's able to go in there and say current assets minus current liabilities. And you can see that we've got very little money there, 8,500. Copy that formula over to get next year, and it goes up to 72,000. You might say, hey, 72,000 is a lot. The ratio is really kind of better to look at. We're still not in good shape. So this is the dollar value of liquidity, and it's called the working capital value. All right, so we're not doing so good in managing short-term assets with short-term liabilities. But overall debt, long-term is what we're talking about here. So debt to asset is easy. It's liabilities divided by asset. Debt to asset, like we talked about. Again, this lines up to the video from last week. So this week's kind of the key to your homework to help you make sure you did everything correctly. Debt to asset is just going to be total liabilities divided by total assets. Now you can look at these two numbers while they're being highlighted, and you can see that liability-wise, we have 431,000. Asset-wise, we have over $1 million. So your answer there is going to be nearly the 0.38. I'm going to leave that as a decimal, so 0.39 is really what that number is. Copy paste that over, copy and paste that over, and it drops. So we would like to see over time, we'd like to see this decline, right? We would like to have less debt tied to our assets. That probably means our business is a little more solvent, and that's what solvency ratios are all about, solvency. How are we handling all that? Well, that's the debt portion. Now remember, in your balance sheet, assets, that value right there, in fact, let me highlight it. assets, total assets equals liabilities and equity added together. You see how those things balance? They're the same. That's the formula of a balance sheet. This is what the business owns, and there's no way to get these items unless you borrow, that's liabilities, or unless you gain equity, which is through earning money or someone contributing money to your business. Those are the only ways. The only way you can gain an asset is to either earn the money or borrow the money or have someone invest the money in your business so you can buy that item. So if the debt portion is 0.39 to 3.5, that means equity must be rising. So if we just go total equity, so that number right there, divided by, we've already looked at the debt part of the assets. Let's look at the equity part of the assets, divided by that. And you know the answer is going to be, get rid of the decimals here, it's going to be 0.61 because these two have to add to 1. Because this is the debt portion of the assets. This is the equity portion of the assets. Assets equals liabilities and equity, so they're going to add up every time. I'll move that over there, and you have that. Now, I'm calculating both of these to show you that, but common when you go for a loan, they're focused probably on just one of these, because once they know one, they know the other. And so it's probably easier for them to understand when you're borrowing money, what are the official assets you have, and what are the official debts that you have. Equity is a little harder to calculate. So really, debt to asset is the one that a lot of people calculate. And again, they know the other. But if debt is falling, and then this one, therefore, must be increasing, that is kind of what we're after here. And so that's what we get. Now, debt to equity is kind of going to throw the assets out. How does our debt and our equity balance? And again, that's just going to be liabilities. So debt, total liabilities, divided by, that's what the 2 is, equity, total equity. And so, of course, we would like that over time to go down as well. Format that to be a single decimal, run that across there, and it is declining as well. So those are some things we want. Now, they are not going to be percentages. They're not going to be dollar amounts. They are going to be decimals, just as I listed for you. So what are the results here? This is where the homework comes into play, or I say what your test comes into play. The results of this, it looks like that from a liquidity standpoint, liquidity is an issue for the business. So we would actually, as a financial consultant, we would say, hey, we got a liquidity problem. We need to reorganize. Of course, there's not a whole lot to do. Reorganize our short-term debt. All right, that's kind of what liquidity tells me here, looking at the top. Hopefully that helps you there. All right, what about solvency? Well, solvency is not bad. We have less than half of our assets connected to debt. And remember, that's equity to assets, so that's 0.61. Now, sometimes you can look at these as a percentage. So that's 0.61 that you saw up there. That's also 61% if you want to talk about a percentage when you're using the items in analysis. So it's not too bad. Solvency is not bad. Only 39% of our assets are connected to debt. 61% are not connected to debt. And this improves over time. So solvency is not too bad. Those are the results that we see there. Okay, liquidity and solvency are definitely balance sheet items. That's what's the health of the overall business. But if we want to grow equity, we've got to figure out how to grow profit. So let's go to the income statement. That's section 2. Now, the income statement I gave you was year 1 and year 2. It's a pick your own vegetable business connected to that balance sheet we just looked at. And we've got revenue, we've got cost of goods sold, we've got gross margin. Gross margin's profitable, that's a good sign. We've got expenses, and we are profitable both years. Income, net income does go up, so that's good. But we've got a little bit of a summary here for our business. If we come over here and look at these values over here, they're just telling us a little bit of extra things like management wise. We don't really pay a manager in this business. So we have an opportunity cost of labor or of management. 40,000 is what we've come up with to utilize. This is some stuff that we've utilized in previous homeworks. We're not looking at this. This is a little bit of debt analysis. We're not going to mess with that much, but we do have production of the vegetables that we harvest and the hours that it's taken, which we're going to use a little bit as well. All right, so that's kind of some stuff that we've got here to look at. Let's look at profitability. And so first one we're going to look at is return on assets. Now I like to calculate return on assets a little bit at a time, each step. So the formula for return on assets in your last video, you've got that, but it's equal to, and it's going to be first your net income of the business. Plus, because it's borrowing, assets can be borrowed on, so we go ahead and add interest expense back, so we don't want it to be part of the equation, because if you're comparing this business to another, maybe the other business does not borrow because they have an oil well on their property. So we don't necessarily, borrowing's not bad, borrowing's not good. It's what you have to do to get the assets. Return on assets is trying to eliminate that factor, so you just add interest expense back. Now the next one is going to be to deduct the opportunity cost of labor, because we're not paying people to work, we are doing it ourselves. And so really, if another business is paying people, again, we're trying to level the playing field. So those are the calculations to look at the return on assets money part. Now the denominator, the bottom part, is the assets themselves. So I'm just going to press equals, go over here to the balance sheet and go grab the total asset value, hit enter, and there it is. So those are the two variables. Equals, just divide the net income adjusted from the assets divided by the assets that we have. So our $1,107,000 worth of assets are earning us the $19,000 back. If I go ahead and look at that calculation, that is going to be 1.72%, or if I come in here and make it be a decimal, it's 0.02. In fact, if I increase that decimal a little bit, you can see it's 0.0172. But return on assets is commonly done as a percentage. So I'm going to put a decimal out there a little bit, 1.72%. That's how I got that. Now, all of this work that I've done can actually be copied over to the next cell, except there's a problem. If I go over here to this formula, this needs to move over, that needs to move over, assets need to move over. That's all good. The problem is that cell right there does not need to move. So when you write formulas in Excel, you can actually put a dollar symbol in front of each thing you don't want to move. I don't want that F to move, because if I move over, the F becomes G. In fact, if I go ahead and just escape there, take a look at the formula. All right, that's the right number for year 2. That's the right number, but look what happens. It moves over, and that's empty. So really, I can just fix that, slide that back over, and hit enter, and now I get the correct number. Now, if you want to do that in the formula, you would just take that F6 and say, I don't want it to become G6. So all you do is come in here and put a dollar symbol right in front of that formula, and that kind of locks that cell, and so when you copy paste that over, that won't change. That is the right number. All right? Okay, so that's a little bit of Excel work. Here's the answer, though, is our assets went up. That's good. Our income went up. That's good. In fact, our return on assets went up. That's 2.9%. So, of course, you would like this to increase. So that's good. You want to also compare this to other earnings. Could you take your money and go earn more than this using the assets that you have? And the answer might be, yeah, you could probably beat 2.9% in the market pretty easy. The trouble is, if the land that you own is something you're not going to get rid of and go invest, it might be the best use of that land that you have. So return on assets is just giving you what your assets are earning you, and you got to kind of compare that to other earnings, but you want it to increase, and so maybe we're on a good track here. Now, return on equity is a little different. Return on equity, this is money that you could probably take and go do something else with. So let's look at what that money is earning us. Well, same idea. I'm going to take net income, except this time I don't want to add back interest expense, because interest expense is needs to be paid in the business. You're not going to get rid of the land, but you do have extra money, $35,000. The trouble is, if you paid someone return on your equity, you had to pay someone to do that for you, then that would be an adjustment, and so it looks like we're losing $5,000 here. If we do our, let me move that down, there's the equity value. If I take that formula and just carry it across, once again, I need to lock that F value. I don't want it to move. So in year 2, it looks like we are finally back up. We're making a little over the $40,000 we might have to pay other people. So that part's good. The equity part equals, go grab our equity from our balance sheet. That equity is that much money right there. And as we earn this money, we could take this money and go invest it somewhere else. So let's calculate those. Equals, take that loss, divide it by the equity. And actually, we're not making any extra money off our equity right now by being in the business. Year 2. Okay, it goes up, but it's still not even 1%. So again, very much like this, same really idea. We can compare this. It's increasing. That's good. We can compare this to other earnings, except when I say compare this to other earnings, using the income that you have. And I think the answer is, for me here, yes. Unless we've got some strategic investments we want to make in this business that we think might earn us extra money, I think you want to try to look at taking your income and investing it in some other venture to help grow your overall net worth, because it looks like that we're not really earning a lot off our additional money in our business. Our assets are kind of making it for us. If we keep investing in them, maybe they'll get better. So we really need to look into alternatives. At least maybe it's alternatives in the business to grow this, or other business ventures, because the extra money that you are earning in this business, having to put it right back into it, it's not really doing a whole lot for you there from a profit standpoint. Now, debt can be an issue. So it's the cost of your debt, interest expense ratio, sometimes it's called. Really, it's just your interest expense divided by liabilities. So what are we paying on debt? Well, I'm going to go up there and grab interest expense. So each year we are paying that in interest, and each year we have this in liabilities. Let's go grab those liability values. I like to show the numbers so we can see them as we make the calculations. I'm going to put a dollar symbol on that. That's what that is. That's the same thing there. And then equals. Divide your 24,000 by what your liabilities are, and lo and behold, it looks like our debt averages about 6%, 5.56%. Carry that across to the next one. Whoa, our debt actually goes up. So we would like to see this decline. We'd like to see this decline. If it's going up, maybe there was a refinance that happened. Not really sure what happened there, but anyway, there's what we've got. All right, so if we go here down to efficiency ratios, this is where you kind of just try to get a handle on what the business is doing. This can be really creative. There could be lots of things here. But dollar value per hour, that's kind of a good one. Harvest cost per hour of work. Got workers here. Percentage of administration to total cost. I've got kind of percent of my overall administration I have here. Is that killing me? How about the change in production? What is production changing? What about cost per pound produced? I'm trying to sell this stuff. I need to know what my costs are. So we've got some variables over here we're going to use for that, and we have to get creative, and I've given you these answers here so you can see what you'll do with that. Dollar value per harvest hour. All right, so how much are we making per harvest hour? They're harvesting them for us. So really, I just equals. I need the dollar value so I can go get harvest hours, and that'll give me the per value. So I'll go up here, and it looks like I'm earning revenue of $176,000 divided by my harvest hour that it takes me to get that done. Enter. Looks like I'm earning $23.88 an hour. If I move across here, I'm earning $26 an hour. So this looks good on the revenue per hour. So every time I hire somebody to go out and harvest, their work is making me $3 more an hour than it used to be. Now, you're not going to pay anyone $23 an hour. That'd be dumb because you can't afford that. If you pay $23 an hour, then you're going to end up with no money at all because you got all these other costs to deal with, administrative depreciation, interest. The harvest salaries are what you are actually paying them for those hours. But you're really looking at what are they picking for me? And they're picking for me $23 an hour and $26 an hour. It's going up. That means they're harvesting more vegetables. Maybe they're worth more, but that's something good to know. All right, what about the cost per harvest hour? So I've got cost that I have into this harvest hour. If I go look at that, that's their salaries. So I'm going to say that equals I am paying for their harvest salaries $48,000 in that year, but I've got 7,400 hours worth of labor. Looks like they're getting $6.49 an hour, and it went to $6.58 an hour. So a couple things there compared to revenue. Looks good. In other words, I am paying out about $6.50 an hour, and I'm getting back $23. Now, of course, I got lots of other costs to pay for, so that's not all there is. But that's a good return. I'm actually getting, looks like about 3 to 4 times the labor. So that's a good return on there and the investment I'm putting into them. Looks like it's also going up. So maybe I've got some people with some raises. Looks like it is going up. So maybe I have a new manager I'm trying to groom to really take care of this for me and do a better job. So I think if I look for ways to invest in labor, that might help me give even a better return. So this is looking like a good deal. All right, I've also got administrative costs. What's the percentage of my administration cost to the whole business? Because I don't want to get too heavy on the top end. So I'm going to go in here, and administrative cost is $8,500 divided by, and I've kind of got a cost of goods sold. And I've also got, I'm going to add that, and I've also got an operational cost. So if I put both those together, I got to put them in brackets, and that looks like about 6%. As I go down here, it drops. So this is good. I'm looking for this to, decline over time. I need to become more efficient in my management. I might spend more money on labor. That's fine because that's earning me more money back. But I don't want to spend as much money on that. I want that to get efficient over time. All right, what about the change in production? I'm going to mark out this first one because change is about the difference. So really equals. Anytime you want to look at change, this could be done across any of these cost items or anywhere. You really take the value where it used to be. So I start a parentheses. It has grown to 7,900 minus, pounds of vegetables, equals. It has grown to 152,972 minus where it started, 113, close parentheses. That's the change divided by where it started. That's always the formula. Percenters there. It looks like vegetable production went up 34.58%. That's really kind of telling me why the dollar value went up and why our harvest cost administrative cost may have gone down because production's gone up overall. So that's good. All right, cost per pound. Here's the thing that we want to know for sure because we're pricing our vegetables. So what are all our costs? Well, the costs are going to be cost of goods sold, plus the cost are going to be the operating expenses. Those are our costs divided by the pounds that we have harvested right there. Enter. All right, overall, it looks like our vegetables are costing us about $1.25 a pound, and they go down. So it looks like we have an improved efficiency, improved output, I should say. So this is a good deal here. All right, now I didn't really ask you for this, but what's the revenue per pound? Let's just look how you would do that one. I'm going to add that to this, revenue per pound. I'm going to move that over to the right so it makes sense, and I'm just going to go equals. What's the revenue per pound? Well, there's my revenue divided by the pounds. And so it's costing me $1.25. I'm selling it for $1.55. So there is what I'm selling it for, and ooh, look at that. So the prices seem to have declined on me. but we still had improved profit because of production is up, I would think. Our costs are down. So this is something good. So those are the things that we would calculate from an efficiency standpoint. All right, so there's kind of the review of your homework in a detailed form on how to calculate in Excel. We're going to be looking at your exam coming up. It's going to be next week, but this kind of wraps up this section, so we want to kind of make sure that this makes sense to you, and I want to make sure that this is something that you can follow. So compare this to your homework. Take a look at this, and then we will kind of be able to wrap this section up. Next week, early in the week, will be your exam, so make sure to prepare for that. There'll be a review that comes out that helps wrap this up. But take time to go back and look at your homework and compare it to what I did here, and hopefully this helps. Thanks.